All right. Today is Monday, the 22nd of May. This is a recap of the stock market activities today. And folks, I got a good one for you tonight. Now, this is supposed to be a members-only video, but I'm leaving it open for everybody, so welcome everybody. And the reason is I'm going to be off tomorrow. And no, I'm not going to be at the beach. I'm going to be working on some videos that I owe you guys, that I've been talking about for a while now. So hopefully nobody's going to get mad at me. I'll be off tomorrow, and then I'll be back on Wednesday. And before we begin, thank you to all of the members who joined us recently, and thank you to all of those who upgraded. Appreciated. Let's start with updates on the morning brief that I issued today. And of course, we did not have any macro guideline. There was no news coming out in the morning, so we had to rely on the technicals of the stock market, looking at overbought and oversold conditions. And I spit out a bunch of charts here, some overbought and oversold conditions. So let's give you updates on these charts. We start with AMD. And I gave you this chart in the morning. As you can see, AMD is overbought in the RSI and the Bollinger Bands. And some would argue even the MACD indicator. And this is a daily chart, by the way. So we're waiting for a pullback opportunity. What do we got today? We got another upside day. The overbought conditions persist for now. And if we look at the candlestick pattern, it looks like a bearish stick sandwich, which once again solidifies the idea of a pullback in AMD. Now, why is this important? We got Nvidia's earnings this Wednesday, which means a lot of you are messaging me, hey Maverick, what is the trade for Nvidia before earnings? We buy, we sell, we short, what is the deal? The problem with Nvidia's earnings is the options premiums are sky high because the expected move is of a 6% plus in either direction. And even if you get the direction right and the stock moves your way after the report is out, just because you overpaid for these premiums, you see the IV crush killing you right away. So why not play a sister chart to Nvidia? And that is AMD. The chart suggests that AMD should go down. And then let's say after the report is out, we see Nvidia down 5-6%. Then AMD should be down a minimum of 3 to 4%. Yet the premiums for AMD a lot cheaper than Nvidia. So I'd rather playing it using AMD rather than Nvidia. We'll deal with Nvidia after the report is out. Let's see what they got. And here's the second chart that I shared with you. AMZ and Amazon, a daily chart, overbought in the RSI, overextended on the Bollinger Bands, due for a pullback. We got the pullback today, here it is. And we should see more of that so long as Amazon doesn't trade above the highs of today's candle. If it does, then we have higher highs to come. And then we got Google. And here's the chart as of this morning. As you can see, way overextended on the RSI and the Bollinger Bands, giving us a reversal candle. One would argue a shooting star kind of candle. But here's what we got today. Another attempt for a pop higher. Couldn't make it. Did not close above yesterday's or last week's highs. And for now, all indicators are suggesting that Google is due for a pullback. If it does, we have 117 as support. Now, here's Datadog, DDOG. This is the chart as of this morning. We're waiting for a pullback all the way to 87.19, which is a Fibonacci support. Here's what we got today. Another upside day, but within range. And of course, if you want to wait for confirmation, it will happen once the stock trades below the low of Friday's candle. Then you got a confirmation that the destination is 87.19 at a minimum. Then we looked at some oversold charts. We start with NEM, New Mat Gold. Here's the chart as of this morning. Kind of oversold on the RSI, overextended to the downside on the Bollinger Bands. What do we got today? A downside day beat within range, but this chart is a little less convincing. It is due for a rebound, but could it go a little lower? The answer is yes. If we zoom in a little bit, we got 43.11. If the chart trades below this number, then you gotta wait for it. It's gonna get a little more oversold and then we're due for a rebound. Here's another chart that I shared with you in the morning. PFE Pfizer. Oversold in the RSI. We have somewhat of a bullish wedge pattern formation. We got 37.37 as an important resistance. If the chart trades above, you buy. Call options, stock, doesn't matter. Here's the update, massive pop for Pfizer. And of course, the technicals aside, there was a major news that came out for Pfizer today that pushed the stock higher. We're going to cover that in the heat map analysis. And the last chart is of the SQQs. This is the inverse index of the Qs, the NASDAQ. And we can see that the chart is way oversold. The RSI overextended to the downside on the Bollinger Bands. So we know that we're due for a rebound in the SQQs. Translation, due for a pullback in the actual Qs. You can play it both ways, whatever float your boat. You want to buy puts in the Qs, you want to buy buy calls on the SQQs, you want to buy shares of the SQQs, that's up to you. But the chart is due for a rebound. Here's what we got today. It got a little more oversold, but we're just waiting for some volume from some catalyst to trigger the Nasdaq to play the overbought conditions on its own chart, and as a result we see the SQQs moving higher. So keep an eye on these charts. Of course, tomorrow we're going to have more of a macro influence. We have more Fed speak. Speaking of Fed speak, we got Neel Kashkari today. Of course, Bullard spoke before that and he said, oh, maybe we need 2 more hikes and then we're done. And Powell said no hikes. And Logan said maybe 1 hike. And another zombie said 3. So we're confused over here. We have no idea what the Fed is actually thinking. And I don't think the Fed knows what they're actually thinking. The Fed is a follower, not a leader, unfortunately. Inflation is the leader. And this dynamic is a dangerous situation because listen to Neel Kashkari, the demon from Minneapolis, talking about the banking crisis. Take a look.
So when I think about this crisis, it really is the outlook for inflation. If inflation continues to be entrenched at a very high level, and the Federal Reserve has to keep rates high to try to bring inflation back down, to break that dynamic, then the yield curve is going to be inverted for an extended period of time, and then these stresses in the banking sector will likely continue and maybe get worse.
In other words, he says, if you want to look for the root of the problem in the banking sector, it's inflation. It's actually interest rates, but the reason why we're raising rates higher is because of inflation. In other words, Neel is admitting that all of this mess is because the Federal Reserve has been callous about the threat of inflation, dismissing it as transitory. And once they finally caught up with it, they were too tame. God forbid the stock market goes down, raising 25 basis points at a time, little by little by little poke at inflation. A massive tornado, and that's supposed to kill it. But now we know that the Fed is still chasing inflation when they're supposed to be in the driver's seat saying, hey, inflation, take a back seat. I'm in charge here. And that could have been done easily if the Fed approached the inflation problem as, okay, we're too late. We have to go Volcker style, shock and awe. 400 basis points in a single meeting. Boom. Shock and awe inflation. And then we could take these rate hikes just as easily as we put them. And if they did that, if they had some balls back then, we wouldn't even be talking about any of this right now. Inflation would be so close to target. Not a lot of damage in the jobs market. No banks collapsing. But because the Fed is so weak, we're here now. And Neel immediately contradicts himself right away. Take a look.
How do I say this? The planning for or the influence of the banking turmoil on your outlook for rates. Is it a time to pause because of that, or is it a time to keep going and fighting inflation?
Well, we have to keep going and fighting inflation. The question is, at what rate do we have to continue to potentially raise the federal funds rate? We've obviously raised it a lot, 5 percentage points in the last year, and we are still trying to get data on what are the stresses in the banking sector. You know, others have talked about this a lot. When the banking system comes under stress, that itself can be a damper on inflation. We're not yet seeing the evidence that the stresses in the banking sector are doing our work for us to bring inflation down. But that doesn't mean that channel isn't there. So that's something where I'm open to saying, let's see if we can get more evidence. Are these banking stresses having some imprint on inflation? If they're not, then the job is solely up to the Federal Reserve to continue doing our part to bring inflation down. If the banking stresses are going to bring inflation down, then we should take that on. And so I don't know yet.
So here's the deal. The Fed is now debating a pause, but it's not really a pause. It's a skip. Now, what is this? A remote control? We're going to pause, skip, fast forward. I mean, these people have no clue what they're doing right now. Neel, you just said that we have this banking crisis right now because inflation got haywire, got out of hand. And a few seconds later, you say, okay, maybe we should take it easy on the fight against inflation because what's going on in the banking sector, the credit tightening will do the job for us. So you want to take that chance? You want to take the chance of easing and letting inflation rev higher again, allowing inflation to rebound if the credit tightening doesn't take care of that? And then what? You have to come back, be more aggressive, and cause more chaos in the banking sector. The key to defeating inflation is to remove the aggregate demand in the economy. The credit tightening is not going to remove the aggregate demand in the economy. It's going to restrict the growth of demand. But so long as people have jobs and access to credit cards and the inflationary psychology is still with us, the aggregate demand will continue to kick in. The moment the Fed eases, the psychology says, okay, time to stampede and buy homes. The banks are not going to restrict credit to everybody. If the demand is high, they're going to have to roll with it. Now that the Fed is pausing, next thing they're cutting, it allows banks to take more risk. I guarantee you, if they pause or skip whatever dumb idea that is, inflation will surge higher again, and then we will see more and more bank collapses. And then the reporter asked him right away, if the meeting was done today, how would you vote? He weaseled his way around, and then he says, but hey, if we pause, it doesn't mean that we're done. Take a look.
But Neel, you're a voting member. If you had to vote today, how would you vote?
Well, it's a tough thing. It's the reason we vote every 6 weeks or so. I think right now it's a close call either way versus raising another time in June or skipping. Some of my colleagues have talked about skipping. Important to me is not signaling that we're done. If we were to skip in June, that does not mean we're done with our tightening cycle. It means to me we're getting more information. Do we then start raising again in July, potentially? And so that's the most important thing to me, is that we're not taking it off the table.
This is all bullshit, Neel. You know it. The moment you pause, we will see an insane orgy across the market, across the economy. The stock market will shoot up higher. Cryptos, trash, tulips. We will see a revival of the housing mania, the auto loans mania, and inflation will come back with more aggression. This is going to be the 1970s all over again. You cannot rely on credit tightening to do the job for you. Credit tightening is happening because you're too late and too weak to the game. And your response is to be later and weaker? Where's the logic in that? The market will not believe a damn thing you people say. If you say, yeah, we're pausing, but watch out. Don't you go and stampede buying those stocks or buying homes anymore, because we might come back. Nobody's going to believe that. Everybody's going to say, okay, they're pausing now. Next thing you know, they're cutting. So we have to stampede now, buy homes, buy cars, buy everything before others do so and prices go higher again. And they will. And then she asked Neel, well, what about the inflation target? Can you move up to 3%, 3.5%? This is what he said.
So 3%, that doesn't cut it for you? 2.5% doesn't cut it for you?
If we move the goalpost when we're behind, there's no reason for you ever to trust us in the future. We have to get inflation back to 2%. And then once we do, if we want to have a debate about what's the right target going forward, let's have that debate. But we can't do it now.
A, buddy, nobody trusts the Fed right now. So if you're worried about credibility, it's already lost. B, if you say you're going to stick to the 2% target, the CPI right now is at 5%. And that's the cooked data. So why are you pausing right now? If you're going to stick to the 2% target, you're at 5 right now. More than double. And you're pausing? That doesn't make sense at all. Where is your commitment to the 2% target? Actions speak louder than words. And the Fed lacks action. The Fed is a wuss. And this is why the market doesn't trust the Fed. The market says, I don't care what the Fed says. I think they're going to cut. And since they're going to cut, I have to stampede right now and push valuations higher again. And to that, Neel Kashkari says,
think when you see the market pricing in the idea that the FOMC is going to have to cut rates before the end of the year.
Yeah, they've been thinking that for a while. And even though we keep getting surprised about how high inflation has been, how entrenched it has been, how slow it is coming down, markets seem very optimistic that rates are going to fall. Now, I think that they believe that inflation is going to fall, and then we're going to be able to respond to that. I hope they're right, but nobody should be confused about our commitment to getting inflation back down to 2%.
Yeah, you got no commitment. There is no commitment at all. The only commitment the Fed has is to serve the oligarchs. That's all there is. And the problem with all of this is, we talked about how Silicon Valley Bank, for example, said we don't need to do anything at all about the balance sheet, because the Fed is bluffing. They're going to cut rates sooner than later. And SVB collapsed. Now the market says the same thing. I'm going to go crazy, push valuations higher, assume that the Fed is done, not only just done, but they're going to cut rates by July. What happens if the market is wrong? Because you got to understand that the Fed is not in charge, inflation is. And if inflation revs higher again, they got one or two choices. Number one, act with more aggression. That means the market is wrong and we will see massive reckoning, a crash in the stock market. Or the Fed surrenders and says, you know what? Yeah, inflation is moving higher, but we have a lot of systemic risk when it comes to banks. We have to rescue banks. So we're not going to raise rates, and maybe we're going to start cutting them, because that's the only thing that will help banks. Deposits are fleeing banks because of the competition of yields. The Fed has to cut rates aggressively to remove that competition, which will mean we will accept living with higher inflation for a long period of time. Maybe 6%, 7%. Maybe we have stagflation. All bad outcomes. And the Fed's credibility is a reason for all of these bad outcomes. Get the job done as soon as possible, because the pain that we're going to get today is a lot better than the pain we're going to get later if we kick the can down the road. You think the Fed understands that? Of course not. And the last point I want to make, what's up with this pause all of a sudden? And it's not really a pause, it's a skip. We skip one meeting, then we go back at it. Why? What's the point? Maybe you want to grab your tinfoil hat because could it be that the Fed sees something, let's say a horrific outcome of this debt ceiling negotiation, be it deal or no deal, something that will act as a 25 to 50 basis points hikes, if not even more, in tightening economic conditions. We talked about the $1 trillion bomb if the Treasury starts issuing bonds. We have a deal. And of course, the consequences are really dire if we have an actual default. What is the Fed seeing to get Powell on Friday to talk the 2-year down, to taper our expectations of 25 basis points hikes in the next meeting? What is the Fed seeing? Another bank failure coming? Another blow up in another sector coming? Let me know in the comments. But for now, let's move on to cover the stock market information for you. We begin with the closing of the indices today, and here we go. The Dow closing negative by 140.05 points, or a decline of 0.42%. The Nasdaq positive by 62.88 points, or a gain of a half a percentage point. The S&P positive, be it flattish, by 0.65 points, or a gain of 0.02%. When you look at the sectors, once again, communication services comes at top, capturing the gold medal. We're talking about Google and Meta, of course. At number 2 for the silver, real estate, we got a rebound here, although yields moved higher today. And then at number 3 for the bronze, we got technology, the laggards for the day led by defensives, metals, and energy. We got a lot of news that the consumer is getting closer into a recession, the consumer recession. You look at retail stores, Walmart, Target, Home Depot, Foot Locker, and you look at the action today. Names such as Starbucks, Nike, McDonald's, all consumer names are down. And then you look at the consumer brands, Procter & Gamble, Kimberly-Clark, all down. The economy is screaming that the consumer is getting weaker and they're getting squeezed. But somehow in La La Land, in the communication services and technology sectors, they see an expansion. What are you talking about recession? There is no recession. There's AI. AI will save everything. So we have the polarity of the stock market right in front of you right now. When we look at the breadth, 63% advancing for the NYSE versus 36% declining. The Nasdaq, 62% advancing versus 35% declining. All in all, boring action, kind of flattish, but we see more names advancing versus declining. The breadth is a little better than last week. On to commodities, futures. What do we see here? The dollar was flattish, believe it or not, did not really move one way or the other. We saw a pullback in metals, either way, led by palladium, down a little over 2.25%. This comes in the heels of massive gains last week for palladium. But the most alarming reaction today is from copper. Copper continues to go down. Once again, the contradictions. If we do have an expansion in the economy, as the tech and communication services sectors say, then how come Dr. Copper, the father of all cyclicals, is not participating? It's actually crashing down. And then we look at energy. The WTI, Brent, crude were all up for the day, be it under 1%. The biggest gainer was gasoline, RBOB, up about 3%, so you're going to pay more at the pump. Heating oil flattish, and natural gas was down big today by about 7%. This comes on the heels of gains of over 14% last week. And of course, natural gas stocks were up for the day. So if you're trading futures, that's a roller coaster. You gotta have the guts for trading these futures. They go up big one day, they go down another. But the stocks, if you're trading Coterra, EQT, Chesapeake, all of them were up today. When we look at softs, we have a mixed picture here. OJ leading the pack with gains of about 4%, and then we have more modest gains for both sugar and lumber futures. Now, lumber moving higher is a good sign that at least we're seeing some movement in the cyclical side of the economy. Lumber moving higher, it indicates expansion. Lumber crashing, indicating a recession. So far, lumber has been crashing. Then the laggards, all down about 1.5% for the day. Cocoa, cotton, and coffee futures. When it comes to meats, down across the board, led by lean hogs, down about 1.5%. And then we got somewhat of a rebound in grains, not for wheat though, but soybean oil, corn, soybeans, all up by about 3% plus. And then you got more modest gains for soybean meal futures, wheat up about 0.25%, nothing impressive here. On the other hand, we have decliners. The winners from last week, rough rice and oats down for the day by about 1.25%. Canola remains the weaker card, down yet again about 1%. And before moving on, we can see the sentiment against oil. This is the most bearish positioning against oil that we've seen in a long, long time. over a decade. When we look at options, the majority of bets are betting against oil, that we're going to see a crash in oil. Why? Because we have recession fears. But mind you, the technology side, the communication services side, the big caps, the AI mania, they say no, we have an expansion coming. If that's true, then these bettors are wrong, and we will see massive short covering in oil. If the Fed pauses as we head to the heat of the summer season, major mistake, you will see oil futures exploding higher. Number 1, the seasonality. Number 2, the mixed messaging by the Fed. Number 3, the massive short covering that will take place in oil futures. On to the big casino, the options market. What do we see here? The volume down all in all. The action was boring today. And the hottest table, of course, the action was all around Tesla. With about 2 million contracts traded today, about 60% of those were calls. You see, the market maker wanted to induce maximum pain by closing Tesla at 180 or below last Friday, but they did close it a little bit above 180. So what does that mean? It means a lot of folks who've been holding these contracts, the 180 calls with the expiration date of last Friday, they had to buy the stock today because their options were exercised. So that's tailwind number 1. Tailwind number 2 is what we talked about in the last video. Massive inflow from the retail mom and pops last Friday and late Thursday. Tailwind number 3 is the massive stampede in buying call options in Tesla, and therefore the stock moved higher by about 5%. But you gotta be careful now because it appears to be really overbought, at least on the hourly chart. We'll take a look at that in a minute. But at number 2, we have Amazon with around 600,000 contracts traded today. About 60% of those were calls. Apple at number 3 with around 600,000 contracts traded today. About 54% of those were calls. Notice that the majority of options traded as calls. So I hear a lot of misinformation, if you want to call it that, around social media, where folks tell me, hey Maverick, there are a lot of bears in the market right now, a lot of people buying puts, maybe that's why the market is moving higher. Your information is wrong. We've actually been seeing massive buying of call options. We've been seeing massive bullishness in the stock market. The bears are non-existent anymore. They're not here. They're playing the banks a little bit. Some are playing energy, but that's about it. The majority of money managers actually believe in soft landing, over 50%. So the sentiment is actually really bullish right now, not bearish. We have greed in the indicator, not fear. Moving on to the unusual activities that took place in the options market today, we begin with the ticker UPST Upstarts Holding. The name has been on a squeeze since earnings, massive pop higher, and somebody's betting that we have more gains to come. They bought the 31 calls. Let's see why. Here's the chart of Upstart, a daily chart. What do we see here? There is a gap at 31.13. The trader says maybe there is more juice to squeeze here. You look at the hour side, it's really overbought, but maybe there's a little more juice to squeeze, and I want to chase that. Number 2, it could be actually somebody who bought, let's say, the 20 calls. They're sitting on gains, and now they want to open a spread by selling the 31. It could be a holder of this stock selling covered calls now that the chart is becoming overbought. What is the significance of 31? It's a gap. So once we get to 31, the odds say we will see a reversal in UPST. But for now, if there is more juice to squeeze, then the trader bought the 31 calls for the expiration date June 2nd, with expectations that the name will move higher and gain more than 12% by the expiration date. They paid around $1.30 a piece to enter this trade, all in all spending around $2.7 million. And then what about the trade for the ticker PACW, PacWest? It moved significantly higher today. We'll cover the news in a minute in the heat map analysis, but it actually moved higher based on bad news. And we know there is massive risk for these small banks to collapse really soon. As rates continue to go higher, forget about what Neel said. Did you hear Jamie Dimon? Jamie Dimon came out today and said, expect rates to stay higher for longer. And we're not talking 5s. We're talking 6, even 7%. He sees something, he slips. He says that out publicly. Then the banksters call him and say, Dimon, what are you talking about? Dude, you're going to freak people out. So Dimon is going to come out and tone it down a little bit in the next few days. But what is he seeing that we're not seeing right now? Because if it is true and rates go to 6, 7%, because inflation is ticking and moving higher, then PacWest is going to collapse. It's just a matter of days. Yet somebody sees it moving higher. For the squeeze to continue, here comes the chasers. You got to be careful of the chasers. I would actually wait for the name to turn around and then short it. But to each his own, because somebody bought the $8 calls for the expiration date July 21st, with the expectations that the name will move higher and gain about 17% by then. They paid about $1.45 a piece to enter this trade, all in all spending around $2 million. And then what about the ticker LOVE, Love? No Love for Love, which stands for Lovesac. Interesting name. Not a good looking chart though. Here's the weekly chart. We have an important line at 22.89. It's already broken. Yet somebody sees it rebounding higher, perhaps due to earnings. Maybe in the earnings call, they're going to say AI. And therefore, somebody bought the 25 calls for the expiration date, June 16th, with the expectations that the name will go higher and gain more than 11% by then. They paid about $1.15 a piece to enter this trade, all in all spending around $1 million. Then what about the ticker TXN, Texas Instruments? One of the strongest names in the chip industry right now. Forget about the mania in NVIDIA and AMD. All of these names crashed in 22. Texas held the line. It consolidated for a little bit, but no crash. But now we have more bad news coming out of China. And we know that TXN has the biggest exposure to China. And therefore, somebody's shorting the name here. And they bought the 160 puts for the expiration date, June 21st, with the expectations that the name will go down and lose more than 6% of its value by then. They paid about $2.30 a piece to enter this trade, all in all spending about $2.3 million. Now, when we look at the chart of TXN, here's a weekly chart. We have a sloping line of resistance that turned into support. So the chart technically is bullish right now, but it lost a lot of steam as of late. We had another line, this time around for support. Is there room for TXN to go down all the way to the support line? The answer is yes. If we introduce Fibonacci levels, we can see that 160-ish is an important support line. If it is broken, down we go to the trend line, which will be at around the 150-ish. And this is what the trader sees. They see that 160 is not going to hold. And if they happen to be a holder of TXN, and this is a hedge, 160 is the line in the sand. If it trades below, run for the hills, more pain to come. And then we have HON Honeywell. Somebody's shorting the name, buying the 185 puts for the expiration date, July 21st, with the expectations that the name will go down and lose more than 6% by then. They paid about $2 a piece to enter this trade, all in all spending around $2 million. Now we'll look at the chart of Honeywell, weekly chart. What do we see here? We know that 184.32, at least this is my number, is an important support. The trader is targeting 185. So what they're saying is if we have a break below 185, we should see cascading of selling. And that means cha-ching for this trade. What do we see here? Maybe this is a reverse ABC pattern. We're going to see the C leg taking us below 185 as support, or in my case, 184.32. Now again, we see these bets against a cyclical names such as Honeywell or Texas. Then you have the mania in Tesla, NVIDIA, Microsoft, Google, Apple. Again, the polarity is really here. The La La Land is the AI mania. Reality Land is we're seeing these cyclical names showing a lot of weakness. Now, a lot of shorts are targeting these names. At least they're starting to. On to the heat map for the day. What do we see here? Mixed picture across the board. The big caps, Apple, Amazon were down, but then you got Google, Meta, Microsoft up. And therefore I said, if you want to chase the mania, use the ETF, use the index. Because if Apple doesn't work, you got Microsoft working. If Amazon is not working, you got Google working. If you want to short, you got to target these names individually. You got to study the charts and target each name individually, not the ETF, the index. A lot of you keep making the same mistake over and over and over again. Can you buy the SQQs when the actual Qs is overbought? Sure, you can do that. We're going to do that. But if you short the SPY and the Qs all the time, you're playing with fire because you need at least 50% of the weighting going negative for the index to go down. The odds are against you. You only short the indices when we have them way overbought or right before massive pullbacks, inclusive pullbacks such as crashes, panics, etc. The strong today was some of the banks rebounding. We got some news from PacWest. They sold about $2.6 billion of loans at a discount, meaning they're actually losing at the deal. But they need the money desperately to cover for any exodus of deposits. And we know $2.6 billion is nothing. That could be lost in a week. So all of the euphoria regarding PacWest that, no, it's going to be alive now. Not so fast. If deposits leave $2.6 billion, that could happen in a week. I would see this as a sign of distress, not a sign to buy the stock. And since we're talking about banks, JP Morgan today was down a little bit, under 1%, but we got some good news for JPM. We talked about this before. They're now expecting $3 billion in income boost because of the FRC deal. That was the deal of the century. They got hundreds of billions of dollars of assets, $3 billion in an income boost, and they didn't have to pay for it. They got paid for it, courtesy of the taxpayer, of course. And among the strong, of course, we talked about the big camps. We talked about Tesla. We'll talk about Tesla again in the charts. Some industrials moved higher, some REITs, some of the oil and gas names, not the big ones, the dividend-paying names, but the smaller natural gas-related ones. The refiners were up. Then we got Pfizer. Pfizer was up over 5% for the day. And the reason is we got the news that we have, among the manias that we have in the stock market right now, it's not just the AI mania. We have the weight loss mania. It was Ozempic, then it became Eli Lilly. All of these stocks shot up irrationally. And now it's Pfizer's turn. Isn't that exciting? Pfizer now has an oral pill that could compete with Ozempic. Now, the side effect of Ozempic is you're going to lose your booty. It takes fat out of all of your body. Do you really want to lose your booty? That's up to you, but maybe the pill from Pfizer is designed to keep your booty alive and target the fat, let's say in the undesirable positions in your body. And now Pfizer takes the lead in the weight loss mania. Look at this, Eli Lilly in orange, Pfizer in blue. Pfizer is now moving higher, Eli Lilly moving down. So we have a rotation out of Lilly into Pfizer. If you bought Pfizer calls today, big gains. Stick with them. Now let's talk about the week. We talked about consumer defensives. We got earnings from Kimberly-Clark. The consumer continues to get weaker. And it's not just staples that went down. You look at McDonald's, Starbucks, even Chipotle today, Nike, all down. So we have corners in the market that say, watch out, the consumer is actually getting a lot weaker. And then among the week, we got some chips, Micron. We talked about this in last night's video, but here it is officially. China is now banning Micron's products. We have a little bit of lack of clarity about which products exactly, but the point is clear. They want to punish Micron. They want to make an example out of Micron. Do you really want to buy Micron and go against Xi Jinping? He wants to crush the stock. He wants to make an example out of it. And this week is going to be critical for chips. You got the China-US tensions flaring up, and then you got NVIDIA's earnings. So this could be a double whammy against chips. And all of the positive excitement that we got over the weekend that, SMH is now positive, if you look at the monthly chart, maybe that's going to go kaput. So keep an eye on chips. Here's the heat map for the ETFs. Again, flattish activities across the board. The good news is we don't have a lot of declines with the exception of the XLP, consumer staples, and the GDX, gold miners. The rest flattish. And the leaders, once again, the KRE, short covering, and PacWest. You got the XBI, lots of M&A activities. The XBI remains hot. And of course, the Pfizer news now excites who's going to be next in the weight loss mania. Then we got the XOP, although the XLE was down. XLE more of Exxon Chevron. XOP more Valero, Marathon, the refiners. More of the high beta names, so we see XOP moving higher, XLE down. When we look at internationals, the dollar was flattish. This was good for Chinese equities, FXI, MCHI, all moving higher. And if Chinese equities are moving higher, we see the EEM, emerging markets also moving higher. On to the charts, and we start with SPY, the S&P 500, 30 minutes chart. What do we see here? Nothing to see. Flattish activities. We gave it another shot at 420. Couldn't make it. Is it the end of the world? Of course not. We could give it another shot tomorrow. But we need something here. We need perhaps a deal from Biden-McCarthy. If we have a deal, we could see a crack above 420, aka 4,200 on the SPX. But mind you, the scenarios are all over the place. Some people assume if we have a deal, stocks are going to shoot higher across the board. Others say if we have a deal, we're going to see a rotation out of big caps into the cyclicals. There's another camp that says if we have a deal, we're going to have sell the news phenomenon. And there is another camp that says if we have a deal, then you got the $1 trillion bomb of a liquidity drain. So even if we have a deal, you got many different scenarios on how it's going to play out. What are the charts saying right now? Let's look at the E-mini futures, the daily chart for the S&P. This one is actually moving higher after hours on the optimism that maybe we're getting closer to a deal. This chart, if we look at the RSI and the MACD indicators, they're all positive, but they're not overbought. What does that mean? Could we see the SPY rallying if we got a deal while the Qs pulls back? Could we actually see the rotation happening? I'm watching this like a hawk. Because if we have a rotation, then it's going to change the game entirely. But if all of them rally together, then I'm going to be shorting the Qs with both hands. And in that instance, yes, you can short the Qs because it's going to become really, really overbought. But let's say we have the other scenario. We get a deal and we get sell the news. Or we get a deal and then we have the $1 trillion liquidity drain bomb. How can we prepare for that? Well, you got to buy some put options. So the way I see it right now, how about buying some put options on the yield-sensitive names? Because if we have a $1 trillion bomb or sell the news, we could see yields moving higher significantly. So that's the hedge, buying put options on the yield-sensitive names, let's say real estate, for example. And then what if we have the rotation? Then you look at the cyclical names that you like in the industrials, in actual cyclicals, defensives, oil, and you buy some call options on those. And what if we have the orgy scenario that everything moves higher? Then nothing to do. You wait till the Qs becomes really, really overbought. You short it. Easy trade. But for now, we look at the E-mini futures for the S&P. Support 4180, the resistance at 4232. Nothing to see here. We look at the SPX. 4,200 is the obvious number to watch. So far, we're facing a little bit of resistance here, but we don't have any reversal yet. And if we have some good news, we could see the pop above 4,200. The SPX is not overbought by any means. We look at the Qs on the other hand, 30 minutes chart, what do we see here? We still have higher highs and higher lows. The chart is still trading above 334.42. We're seeing it stall here, and the reason is you got Apple down, but then you got Google up. You got Amazon down, but Microsoft up. And therefore, the chart stalls. And a lot of these big cap technology stock charts are becoming overbought. And they're getting some bad news, such as Apple today. What about chips? The China tensions? What if Nvidia bombs? So we have a lot of risks here versus the SPY. If the chart goes down and it cracks below 334.42, I'll be a buyer of calls on the SQQs. If we get a massive pop because we have a debt deal, a debt ceiling deal, then if we look at the chart of the futures contract, the daily chart, look at this. It's already overbought. It's going to become even more overbought. The weeklies will become overbought. And that's a solid sign for a pullback, easy trade. You buy the puts, you get the pullback, in, out, hello, goodbye. For now, both the RSI and MACD are positive, but way overextended. Support 13,740.75, aka the August high, and the resistance at 14,000. And I think this one will be sticky. You're not going to go above 14,000 easily. IWM, an hourly chart for the Russell 2000. What do we see here? We talked about the bearish consolidation pattern. Is it a product of OPEX or is it a legitimate bear flag pattern? Now we know that it was a product of OPEX. The market maker wanted to park the IWM below 177. They got their wish, and now we see some short covering in the KRE due to PAC West and the IWM moving higher. And the resistance now becomes 179.10. We can round that down to 179. Support 177.30. But the IWM is really volatile. If we have bad news about regional banks coming up, IWM will go down. We need to see more. We need to see the 180s, 190s before we say, okay, small caps are now playing catch up and this is bullish, not bearish. Otherwise, it is just a matter of time before the IWM goes down and loses 174.22 as support. Dixie, 4 hours for the dollar index. What do we see here? It caught support from 103 and then rebounded by a little bit. Is this an ABC pattern that will take us all the way to, let's say, 104? And if the dollar continues to surge higher, you're gonna see the algos reacting by dumping down. For now, they're playing it cool. But a reminder, the post-SVB rally was partially done or perhaps majorly done because of the Dixie moving down. And the same goes for the so-called October bottom. The Dixie topped at October. Now we see the divergences. We talked about the Qs versus the HYG, the Qs versus copper, and then we got the Qs versus Dixie. Dixie moving higher, Qs moving higher. One of these two is lying. One of these two will stay up, the other will go down. In the case of the dollar, the bearish outlook says, what if this is a bear flag pattern? Sooner or later, we lose 103 and down it goes. If that is the case, it's important from the equities market perspective, but also for precious metals. We're talking about gold, of course. Gold not looking pretty good today. It's not oversold yet. We could see more pain to come. We could see 1928. We could see sub 1928, but it all depends on the Dixie. If the Dixie loses 103, we could see gold moving higher again. But then gold has two enemies. The dollar is one, yields is the other. The 10-year yield specifically. And the 10-year has been moving higher. So that's not good. You got to see both of them down. Sure, we could say the dollar goes down because Kashkari said maybe he's going to vote for a pause. But will yields go down now that we have a $1 trillion liquidity drain bomb that is about to hit the bond market? Hard to see gold rallying higher if we have a pop in yields. And the same goes for the SLV silver. Although silver is considered overbought for now, It could get a little more overbought, but it is, for now, overbought, worthy of a pop at least, a rebound. We did not get a follow-up on the rebound from Friday, but so far so good. It becomes problematic if the SLV loses 21.57. Then we got a problem. We have more downside coming for the SLV. What about Brent oil daily chart? What do we see here? Consolidating under 77, but it's running out of time. It's time to put up or shut up. Put up meaning you gotta crack above 77 ASAP. Otherwise, this consolidation is a sign of weakness and lack of buyers. And if the buyers don't show up, the sellers are gonna. And the sellers could take us below the double bottom formation. That's going to be a bad outcome for oil bulls. How about the 2-year yield, the daily chart? What do we see here? We have a breakthrough above the resistance line. This is not good, folks. This is indicating that the Fed will have to do more. This is indicating that we have a massive tsunami of bonds about to hit. And if yields move higher, more banks are going to blow up, and we're going to see more pain in the technology and the speculative side of the stock market. What is the threshold? It could be 4.4, could be 4.59, could be 5 even, but there is a number that will trigger algos. You'll know it when you see it. TLT moving down to 100.28. You can round that down to 100. On my chart, it says 100.28. It doesn't matter. We see the TLT down, and it could go down even more. Don't touch it. Just leave it alone for now. VIX, 4 hours chart. What do we see here? Look at the RSI back into positive momentum. The same goes for the MACD indicator. We have a closing above 17. What is the VIX saying? You can look at it as a bull flag formation. If that is the case, the VIX will pop higher. Why would it pop higher? Fed speak, macro data, dead deal fiasco, anything could happen. But the VIX is now saying, hey, I'm ready to go. Just give me something. Give me a catalyst, and I'm ready to go. If the VIX is ready to go, then the S&P and the Nasdaq will be down. Apple, the big kahuna, an hourly chart. What do we see here? The obvious, of course. We got the gap down, perhaps forming a head and shoulder formation. Another way we can look at it is a bear flag consolidation pattern. Now, we're not seeing significant damage at all. We don't have any reversal signal. We don't have any damage on the chart, technically speaking. That only happened if we have a loss of 172.5. And by the way, if you look at Apple's weighting of the S&P 500, it is at the top range from which it pulled back before. This is unsustainable, folks. When I read the headlines that Apple is now larger than the Russell 2000, when I see that Apple is now larger than the British market, than the DAX, the German market, and a few markets and economies combined, this is not a reason to celebrate and say, wow, look at Apple, such a great company. It could be a country for that matter. It should be a sign of, oh my God, the insane have taken over again. And when the insane take over, they open opportunities because they've taken the valuations out of whack. That means we have yet another reversion to the mean. Tesla, an hourly chart, what do we see here? We talked about the bearish formation at around 180. Is it a product of OPEX or a legitimate bear flag? We now know it's a product of OPEX. The market maker wanted to close below 180. The buyers wanted to close above 180. It closed pretty much exactly at 180. But we've seen a wave of buying Thursday, Friday, and today, be it buying stock, be it buying options. And of course, those who held these call options with the expiration date of last Friday are now exercising and buying Tesla at 180. So we have a lot of buyers today, and they got the chart all the way to the next resistance at around 189. Now the RSI is really overbought, so the expectations are for a pullback in Tesla. If it keeps 180 as support, so far so good. If it loses 180 as support, it was a trap. It was a premature stampede exit. There was more pain to come. Last but not least, what about BTC tulips, Bitcoin? What do we see here? Holding on to support, 26,555. That's the good news. Another piece of good news is the RSI and the MACD indicators appear to be bottoming and turning bullish again. No confirmation yet, but there is also a risk that Bitcoin will break that support and we're going to see somewhat of an algorithmic selling, which could be fast and furious. So you gotta have the hedge. Sure, the MACD is working your way, so is the RSI. The chart been holding. It did not crack. Maybe we're going to have folks coming from the sidelines and buying BTC. Maybe. But what if the opposite happens? What if it loses 26,555 as support? Do you have a hedge against that? So what is the harm in hedging? Something to think about. Lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the services PMI along with the manufacturing PMI. Combined, we call them the flash PMI. This will be really important. What is the headline reading on both services and manufacturing? Most importantly, what's going on with prices paid and prices received? Going up, going down? Those two readings will have important implications on the algorithmic reaction right before the bell. We also have new home sales. This will be an indicator for aggregate demand And for the Fed, is there a risk of a revival of the housing mania? I would say yes, but they have to see it to believe it. And then we got Dallas Fed President Lori Logan. Last week, she said she favors a rate hike, and the data doesn't merit a pause or a cut. Is she going to go with the group think and say, okay, yeah, maybe we're going to pause? If that is the case, then you can bet on it, folks. They passed the memo. Somebody passed the memo to the Fed and to Janet Yellen. You gotta pause. They gotta pause because we have something about to blow up. They see something that you and I are not seeing right now. Think about that. Think about what you think about. And with that, folks, this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again, not tomorrow, unless there is an emergency. Wednesday. How about that? Good night.
I need a reason. Don't say money. Why do this?
Why not do it?